So I'm Brian Ladd Group. Steve LaCrosse here is joining us today, and we're here to go over what's happening here in real estate in September. But we're going to try to bring a little bit bigger macro perspective on what's happening out there in the real estate market, and hopefully we can help interpret a lot of the concerns and sentiments that people have and integrate everything from, what Jerome Powell was talking about today with the Fed and monetary policy and interest rates and all that. And hopefully you'll be able to leave here in about 20 minutes and have a more holistic, better understanding of the dynamics of what's actually happening in the real estate market so you can create your own plan, and course of action from there. Rana, were you able to pull up those results?
Yeah, they should be on there now. Can you see them? It's probably, I mean, I know I was going to make a prediction before before we saw them pop up. It's the range you'd expect. There's a lot of optimism. So for everyone that doesn't know these Menti polls, the bigger the word, the more people put that word in, the smaller the word. Um, the fewer times it was suggested. But you can see confused, confusion, confusing. That concerned, cautious.
Cautious, unsure. This is
Yeah.
this is what we're talking about on a daily basis, isn't it?
But it's an interesting visual to see that overall there's optimism. That's the one that came up the most. It's the biggest. And then all around that is like a cloud of confusion and cautiousness. So hopefully we can help that part of it today.
Yeah, and I would agree with that. I think there's a lot of reasons to be optimistic about the housing market, despite what we're hearing on the job front and on the inflation front. We're going to talk about how all those seemingly disparate things come together to lead us into a fairly robust and fairly stable housing market right now. But with that, let's get to business and let's try to keep this short and succinct. Everyone has the chat function available. Everyone has the question and answer. So if you have any questions, please bring those up and we'll try to address those in real time. Mark Zandi, he's chief economist over at Moody's. He basically, this was a quote he had a couple of weeks ago, and he said the risks are increasingly high that we are going into a recession. We're not there yet, and this may get turned around, but it's becoming increasingly hard to do with each passing week. And so this is what a lot of people are hearing from the Fed, from politicians, and they're having a hard time marrying that with or interpreting that to make a housing decision. And a lot of this has to do with inflation and the Fed policy, which affects mortgage rates, which affects housing. Steve, you were getting pretty data wonky on this today. I know you were listening to Jerome Powell's comments and you were looking at the futures of 10-year bonds. Would you go a little bit into our next couple slides? Here we've got one on inflation. The next one, we have some unemployment, but would you want to try to do a couple minute synopsis on what we're seeing in the data right now and how that's affecting the economy?
Yeah, absolutely. So the start of this chart, money was cheap back in the pandemic. People, they were trying to spur activity. It led to a point that goods, services, all of that ended up costing a lot more. You can see that peaked out in 2022. And this has probably been the number one thing the Fed has been watching for the last year and a half, was getting this back into the range that they would like, which is somewhere near 2%. Um, it, they have said, and you can see it did recoil until, sometime in 2024. And since then, it's been stubbornly sitting around that 2.5 to 3% level. And the Fed has been very cautious about overstepping and trying to stimulate too much too early to, put us back into a situation that, can lead to higher prices. And instead of growth, it ends up putting us into a situation where we stall out a little bit. And so inflation has been the number one thing. And this year, everyone knows back in April, it was the beginning of tariff discussions, and we're continuing with that today. We talked to our new construction, our builders. We haven't seen it necessarily roll out in terms of direct costs, and so it still remains to be seen a little bit in the market. A few of our clients are in the service in production, and they haven't passed those costs on to their customers yet. The initial reaction was, we're going to eat some of these costs, and then now it's been lingering for long enough that those costs are going to have to come back to the market and come to the consumer. And so this is where the Fed has been watching mostly, but in the recent, I'd say, 2 to 3 months, unemployment has been the shift to their focus. And Brian, I don't know if you want to jump into the next couple and talk through unemployment.
Yeah, and really, let's talk in big macro terms. And you guys may say, "Hey, why are you spending so much time on this?" And we'll get to it in a second of how this directly relates to you and housing decisions here in Bend. But really, the Fed's policy has been to try to tamp down inflation um, while without making too much unemployment. And that's the one issue that we're kind of struggling with right now, is because generally, if unemployment is high, that means it's a softer economy. People are not spending, and generally, inflation's not an issue. But we're at this kind of crossroads where we can't quite figure out what the economy's doing, and the tariffs are holding these prices up high. So they're kind of running out. They've got two levers. They've got a couple different levers at the Fed about how much they hold on their balance sheets and what is the overnight Fed funds rate that they lend to the banks. But historically, the more money they put out there, the more spending it creates, the more job growth it creates, but it might cause a little inflation. And right now, they're just balancing between this unemployment pressures and inflationary pressures. But what is very clear is that job growth has stopped. It's stopped. It's been at the lowest level we've been at for many years. This dates back to the 2000 aughts, 2009, 2010, 2012 of this little job creation. And so they're afraid of tamping this down too much by keeping interest rates too high. That's what, there's a lot of people in politics right now who say interest rates should be much lower. The Fed's worried about higher interest rates. The reason we're going through this is that they're trying to stabilize all this. And the reason we're talking about this is because of interest rates. And Steve, on mortgages. Steve, do you want to jump in here and kind of where we stand right now,
Yep.
and what are the real factors behind these mortgage rates, and how that relates to the data that we're talking about?
Yeah, absolutely. There's a lot of discussion about the Fed doing what they can with the Fed funds rate. What we're looking at here is mortgage rates. That's what directly affects you as a home buyer. And so what ends up happening is you have people watching these job numbers, the inflation numbers, the job numbers. In August, even though there has been talk about what's the Fed going to do at their meeting, which just concluded today, when the jobless numbers started to come out in early August, when that report was released, you can see what happened with mortgage rates. So everyone that's watching this, mortgage rates typically follow the 10-year. And so the yields on the 10-year are more reflective of what's happening with mortgage rates, whereas the Fed funds rate is the rate that banks charge each other to borrow money. So it's the availability for home equity lines of credit and balances between banks. And so what we've seen over the last 30 to 60 days as mortgage rates have started to ease. And that was all in anticipation of seeing what's happening in the economy in general and them anticipating what does that mean moving forward. And so we've seen that. And I think if you go to the next slide, Brian, you can see what are people predicting with regard to mortgage rates. Will that decline that we just saw over the last 30 days continue? These are the projections. These are the latest projections as of about a week and a half ago. Now, for what it's worth, mortgage rates right now are somewhere between 6.25% and 6.5%. And after the announcement today, they're hovering more in that 6.25% range, which then begs the question, why would it be that if the Fed is now starting down a path of lowering their rate by a quarter today and potentially a quarter in the future, why are they predicting that a year from now we're still at the same rates? The chart here explains that a little bit. So the caution, Fed cutting rates does not equal mortgage rate relief. We're looking at mortgages, and the line that we've got indicated there is September 19th of 2024. That was the day after the Fed announced their rate cut, and that was a half a point. And so that had been baked in for the couple of months leading into that rate cut, where people knew that was going to happen. People started to act on that. Mortgage rates started to come down, and you can see what happened from that point. We haven't gotten anywhere close to that. So the caution here is if you're a buyer and you're waiting for rates to come down, that doesn't always happen because you're hearing in the news the Fed is now embarking on a policy of potential two more rate cuts this year. We
Yep.
would just advise some caution because it doesn't always equal mortgage rate relief. And then there are some other elements that we would be happy to talk to you about.
Yeah, and in fact, I mean, we have this chart that looks very official because Fannie Mae and the MBA and Wells Fargo are all very credible sources. giving us their projections for interest rates for the year. But all these sources a year ago were all predicting that interest rates right now would be between 5.75 and 6.25. And we're stuck at about 6.5 right now. So we take this all in a grain of salt. But what we clearly are not seeing is dramatic drops in the mortgage rate right now based on the current Fed policy. It's going to have to do with a lot of things. But what we are um, recognizing right now is that this is affecting buyer behavior with all the sentiment about recession out there. 2 out of 3 Americans think that we're going into a recession. And 3/4 of them feel that what the news that they're seeing right now and current events are affecting their financial decisions. And we are seeing that show in the data. But we also have a lot of data points that show that there are people that are still transacting, and we're actually seeing volumes up from last year, and the things that are probably in conflict with a lot of people's belief of what's actually happening in the market. But given the fact that we're going into recession, given the fact that interest rates are staying stubbornly high, even with all of that, most economists are still saying that, hey, we're going to continue this moderation in the housing market rather than a steep decline or a decline in general. And that's really where we've been since 2022. Jerome Powell's goal outside of housing and within housing, because housing is such a big part of the economy in the US, was to try to create a soft landing to slow down spending, to slow down purchases, to slow down adding on debt. And he was able to do that. And that's really what we've seen in the housing market since 2022 all the way through now. There's very few times in history of housing where prices are this stable for this long. Usually it's like a 7-year cycle up and a 1 or 2 year cycle down. But we've been almost sideways in housing prices since early 23. We had a big bump up kind of from pre-pandemic to the prices that we're at now are what, about 30, 40%. Steve, kind of depends on which segment of the market, somewhere in there.
Yeah.
But we've been very moderate. And to be honest, we're seeing kind of the forces that are all coming together are pointing to continued moderation.
Yeah.
Steve, how do you like, is this in line with what clients are saying on the front lines when they're thinking about selling or purchasing a home right now?
Well, yes, and I think this is why there is so much talk of confusion in our last market update that we just put out. There are confusing numbers, right? We've run up so much, it needs to have a correction, yet prices continue to be stable. And so if we go to the next one, it's the local version of this. That's the national level. This is local. This is Bend median sale price. And so what does this mean? This isn't just we're always rosy and optimistic about the market's always going to be good, but demand is there, right? Demand is keeping those prices in check. And it's also, if we're looking at the takeaways from this, it's keeping it in check on both ends, right? It's keeping every time prices come down a little bit, it's met with buyer demand and it bumps it back up. And then every time prices push a little too far or it seems a little too ambitious, sellers are trying to extrapolate what had previously happened into what's going to happen next, and buyers will hit the pause button. And so, anyone who's been reading our market updates, you can see this chart looks a lot choppier than that last chart that's smoothed out on a national basis. But this just keeps telling us that there are buyers that are coming in the market that are not allowing this market to drop. And we've gone into before in our state of the
Yeah.
markets and our prior webinars why that is and where those buyers are coming from. But it shows stability is the bottom line. And if you look at this chart, like you said, Brian, when you have that kind of run up, you usually expect there to be a recoil of some sort. And that recoil is consistently met to the point that we are trading right in the range where if the pandemic didn't hit and we just continued to move at the level that we had moved prior to the pandemic, if you draw a straight line across that trend line, we're pretty darn close to it.
Yeah, I mean, if you were to take a line from 2010 to 2020 pre-pandemic and continued that straight, we're as if the pandemic boom and then couple year moderation had never existed. And so we could get really micro on this data as well, like what you might see here in that 2023 era when home prices went down a little bit. There's kind of that U there. That's the inverse of what was happening with interest rates. So that was the couple quarters where interest rates got darn near 8%. These were 7.5, 7.75. And but I want to hone in on a comment that Steve made. Every time there's a break in interest rates, buyers are more than willing to get back in that market. And so we're at a point right now that we've been in parts of the market. I've lived through the early 2000s. We had a softening housing market then, obviously the great recession of the 08, 09, 10, 11. But there were times where you couldn't find the buyers. No matter how much you turn the dial on pricing, the buyers were simply not there. And it was kind of, it was worrisome of trying to figure out where that demand was eventually going to come from. I think we're in a very different time, and buyers are definitely maxed out in the sense that housing prices are very high and interest rates are very high, and they're struggling to get in. But anytime there's any sort of pullback from that, buyers are re-entering the market. And anytime those interest rates slip down, like clockwork, within a couple weeks, we're seeing those buyers re-enter the market. So we're showing, a real floor to that price because there's still robust demand. There simply have been priced out of the market. The other thing that we've gone into in great detail in the past, and I don't want to rehash it too much today, is this is median sales price for the last 50 years, and the red arrows show recessions. 81, 1990, 2001, there was that brief 1 or 2 quarter recession. 2008, the really short recession we had in the early pandemic. And then they went ahead and put on this graph, the red arrow for right now, whether we're in a recession or not. But what it clearly shows is obviously the 2008 recession was kind of an animal of itself. But generally, prices in recession for houses are flat or most of the time actually appreciate during recessions. And a lot of people are confused by that. But generally, recessions are such softening of the economy that monetary policy tries to put a lot of money in the market, lower interest rates, and eventually that trickles down to mortgage rates, and it gets people to buy houses. And housing is usually the part of the economy that helps lead the US economy out of recession. So we often see a lot of home sales kind of in the middle to later parts of the recession. And generally, it's not as the recession, even though a lot of people have that in their mind, if they have personal insecurity about their job stability and things like that. But that's why that a lot of these experts, and this is coming from Fannie Mae, who buys the majority of the mortgages on the secondary market, or on the do they hold the mortgages and resell some of them, correct, Steve? Fannie Mae?
Correct. Yep.
Yeah, and so they have to know where housing prices are going because it interacts with the amount of risk that they're holding on their balance sheets, and they're predicting that the next 5 years of price change, despite the fact that there's consensus that we might be going into a recession, on the low end are 6.7% increase in prices in the next 5 years, all the way up to 27% price increases for the next 5 years. And so what we're having trouble is finding any real good data that is showing a housing crash. And I'm not saying the houses prices won't go down, or we definitely don't have a crystal ball. But I think if we can separate the emotion from the headlines that we're seeing, and especially if we ever see a recession in the headlines, from housing, I think it'll allow our buyers and sellers to have a little bit more clarity and confidence in those decisions. Steve, when you see a chart like this where Fannie Mae is predicting on the low end positive price appreciation of 6.7% over the next 5 years, does this marry with what, one, you feel, and then two, what your clients are feeling right now?
Yeah, I mean, if you what I see when I look at this chart is a very long-term view, which is what we've always said. Housing, your decisions on housing should be a long-term view. If you are an investor and you're looking at the micro, you're looking at the next 2 to 3 years, then the exact timing and the exact rate and the exact everything make a big difference. Most people are purchasing homes because they need to live somewhere, they're taking a new job, they need more space, they need less space. And when you look at this chart, you can pretty clearly see outside of the very big anomaly in the mid 2000s that I think we've gone through enough as to what caused that and how it's very different now. But the overall trend is housing is a very good spot to have your money invested and it also provides, outside of just a portfolio that you might have as an investment, housing more than anything else is something that provides a real tangible value. And so when I see this, this is some of the stuff we talk with our clients about, is what is the goal here? What is the expected duration of your time being in the house? And you'd be hard pressed to zoom in on any 7 to 10 year period in that chart we just looked at where housing didn't go in the direction that buyers want it to go in. So
Yeah,
let's
and
look
this
at.
is where, I believe that this is always when we try to decouple our clients when they're marrying investment, not just investment, speculation to their housing purchase. I think we always try to separate what does your primary house mean for you in security and stability, and can it be a good asset that appreciates over time, but it shouldn't be a speculation based on 1, 2, 3 years because it is such a big asset. The reason they give 30-year mortgage is because housing generally performs well over the long term. But in short terms, it does have some variability. But that said, what I want to quickly get to so that we can, I said 20 minutes, we're now at 22. So I'll try to wrap this up. But I want to debunk a few of the headlines. A lot of our clients are saying, hey, I'm seeing headlines that inventory is up 50% year over year. Won't that flood of inventory bring down prices a lot because there's simply too many homes? And I want to put this in perspective a little bit because a lot of people, journalists, newspapers, have a lot of clickbait headlines and whatnot to get people excited to read an article. And it's disingenuous. Like we'll see a month over month housing prices down 10% in Ben. And it really just had to do with the median. We talked about it before, a median price, and it didn't have the data set of a couple high-end homes. And it's really misinforms the public. And I think the inventory thing is as well, because we had many years of really low inventory during the pandemic, but that was a historical anomaly. And sure, while inventory is up, we're up about 15% over this time last year. If you look at, that line that goes horizontal here, that's the 10-year average of inventory. So we're right on inventory levels of 2015, 16, 17, 18, 19. And we're about the balanced inventory level that we've always been at. And in fact, we're past the inventory peak for the year and we're already on that pullback. And generally, we see that lowest amount of inventory December, January, February of every year. Steve, what could be a quick buyer and a seller takeaway you have from this chart here?
So we see it often every year. People are waiting as the new inventory is coming on. Buyers are waiting and going, well, let's see what comes on next week. In the absence of
Yeah,
activity, let's see what comes on next week.
yeah,
And then inevitably, the number of new listings that come on starts to go down.
yeah,
Some of the sellers get tired. They start pulling their homes. And so, I mean, this chart is, you can see it's a yearly cycle that we go through. And so buyers that have been sitting and waiting for something better to come along, it would be wise to look and see if there is something out there that maybe it's worth revisiting again. And from a seller standpoint, there is activity that can still be had at this point. You are facing less competition. Some homes are coming off the market. Buyers who have been waiting start to see have a little bit of a fear of missing out, and they want to act and they want to get settled and they want to move forward. And when they see that there's fewer homes to choose from, it can cause, so let's not write off the season because we're heading into the fall and eventually the
yeah.
winter. There's activity that happens every year, and it
Yeah, and
usually is based around this.
absolutely. And I think you hit them both sides. But what I would also encourage, and I think we were talking about internally, is we still think that there's a buying opportunity right now because of some of the softness in the market. And this time of year, the lot of the homes that have been on the market were overpriced at the beginning of the year. This is where some price corrections happen. This is where a little bit more negotiating power happens for you as a buyer. But then also, if the inventory you're looking at right now doesn't work for you, most likely it's not a 2025 purchase. We're feeling that, your buying opportunity, we passed the peak for the year. If everything on the market right now doesn't work for you, realistically, you're going to probably wait for that next peak, which is probably an April or May of 2026, right?
Yep.
And so, but then, like Steve said, we often have some of the most success for our sellers in those fall and winter months when all that inventory is off for a well-priced, well-positioned home. We're often selling at 99% of list price to sale price or sale price to list price. if it's well positioned in a lower inventory time of year. So I think both sides can have success, but I think as a buyer, you need to acknowledge that your peak for the year of what you have to look at is already in the rearview mirror. It's already 30 days in the rearview mirror. And if we were to put September data on, which we don't have right now, we're actually seeing higher absorption than there are new inventory right now. So we're going to see that active inventory continue to fall. The next one here is absorption rate. This is a new piece of data that we've been talking a lot about in the Ladd group the last couple of months. So if you've been around us, you're probably tired of it already. But the reason I want to bring this one up is it's really important because we have a lot of misconceptions. A lot of sellers come to us and say, hey, why is my home not selling? When I look at the 20 homes that are in my price range, I'm right in the middle. I'm fine, right? But what the real the real data shows is that in any time period, and this was a monthly breakdown, about 23% of the inventory actually sold. And so there was very few times during the pandemic where we had 100% of absorption of everything on the market. And what people don't realize is that homes get withdrawn from the market. They go off the market, come back on the market. They take 6, 9 months to sell. And I'm not saying that's the same for all price segments and all product types. But what we often encourage our sellers to do is say, okay, it's great that you're in the zone, but if only 23% of the inventory in your price range is going to sell in the next 30 days, are you truly in the top 23% of price point, features, etc.? And if you really aren't in that top 20, 25%, you're kind of out of the running. If you're in the middle of the pack, you'll just stay on the market. New homes will come on the market, they'll sell, other homes will come off, new homes will come on, and there'll be continued inventory turnover. But you can't stay in the middle to bottom of the pack in a market that's only absorbing about 23% of the homes. Fair? Steve, how would you interpret that? And would you have a quick takeaway for buyer and a seller?
Yeah, I mean, I would say when we're talking about sellers, are you priced and marketed in the top 25%? That's the question you should be asking yourself. Exactly what you said. There's 20 homes in my category. Am I in the top 5 of those?
Yep.
You're not aiming to be right in the middle of the pack unless you're okay with selling it 60 to 90 to 120 days from now, right? This is what's happening on a monthly basis. How many of those homes are turning over? And so again, it's all the conversation around what are your goals, what are your expectations, and being able to position you in the best position for that. And so this goes back to what we were talking about. There are pending sales. There is activity that happens every year at this time. This year it jumped a little bit sooner. And so this last month, and this very well could go back to the mortgage rates that we saw that have been declining steadily for the last 30 days, and it caused new buyer activity. People jump back in. And so, if we're looking at how do you prepare yourself as a buyer and how do you interpret this as a seller, there's still competition out there as a buyer. There are opportunities, and this is historically the time of year where you can take advantage of some seller motivation. You might be able to, have some sellers starting to see the winter coming and just wanting to, move on from it. And so, although there are good opportunities that can be had, there are still people that are out there, and this is what we've talked about with that buyer demand just keeps reappearing. Every time there's an opportunity for it, it reappears. And the seller takeaway is maybe it's not necessarily the right move to just withdraw your home because it didn't sell over the summer. We're seeing more buyers stepping into the market from August into September. Let's continue to watch that and see what happens in September, October, November. And so it is important that you're watching this on a daily, weekly, monthly basis. That's what we're here for. And it allows you to make the right decision for you based on what's actually happening in the market, not necessarily just what's happened in the past.
Yeah, and I think this data is probably not congruent with what a lot of people believe based on the headlines. They think housing is in a housing correction, housing recession, and we're up 10% year over year in the amount of new pending sales. And we're actually seeing kind of tailwinds or factors like on a daily basis that's is just starting to show up in the last 1, 2, 3 weeks, Steve, right? We're seeing some of the most pending transactions that we've seen in a long time.
Yeah, which again is why if we're taking that into account and then we go to the next slide, this is where the confusion comes in. Pending
Yep.
sales are ticking up, but there's more negotiation taking place or there's bigger price reductions. And so the percentage that's received is going down. The sale to list price percentage is going down. And so
Yep.
people are going, I don't understand. The median went up last month. The days on market went up last month, but there's more pending sales, but there's more negotiation and price changes. That's
Yes,
confusing.
yes, 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 and yes. It's a confusing market. And I think if you were to look at this, this shows that the sale price on the house, what was it as a percentage of the original list price? We're at about 94% right now, which means that from the original list price, things are selling at 94%, 6% off the original list price. Now, the fact is, though, that there's a lot of homes, there's 7% of the market that sells over list price right now. There's a good chunk of them that sell within a half percent, sell at 99.5 to 100%. This is the original list price. So if I were to pull up another data set and say percentage of sold from most recent listing price, which means you finally made the price reductions to get it down to where it should be, that one's like 98.5 to 99%. Unfortunately, there's a lot of mispriced homes. And when you see these big price corrections, it shows softness in the market. And it's not necessarily softness. What we've seen a lot in the last year or two is sellers didn't want to believe that housing prices were flat the last 3, 4 years, like we opened the data set with. And they said, it only takes one buyer. I'm going to go for it. And those are the homes that were sitting extended days on market. We saw bigger price reductions on those before they sold. But yet there's a good section of the market that if people were well priced or they made price reductions quick enough, they've been able to sell quite quickly. So I think it had more to do with mispricing and misconceptions of where the market actually was the last couple of years. But I think everyone's starting to kind of figure it out right now, and we're seeing more realistic pricing happening. But yeah, this is interesting as we go to close out this year. I mean, I guess the first 3 quarters of the year, we're at 94%, which was pretty different than in 2021 when things were selling 4% above list price. Historical average is about 96% or
Yep.
so
Yeah.
from original list price.
And I will just point out, I did go a little deep into the data just to pull that exact what you were saying, Brian. So 20% of the sales in the last 30 days were at or above list price. So
Yep.
20% were at or above list price, 20% were 10% or below list price. And this is an average, it's not the median. If you were to take the median, it would be closer to like 96%. So there's a larger number of these that are happening on the upper end, but what's happening is there are a few that were 60% of list price, 65% of list price. And so it's dragged the average down. But your point is valid. 25% of the market is selling within a week. 20% of those homes are right at or near list price. Just one last little piece on this. Of the 94%, it's about 2.4% of negotiation and about 3.5% of price reductions. So there's a combination of the two going on, which again is what leads to a lot of the confusion.
Yeah, so there's a lot of data points. Hopefully, it distilled down that you maybe have a little better understanding of what's happening in the real estate market today. And please follow up. We're going to send out a follow up to everybody that registered or attended the webinar. If you have any questions, reply back to us. We're always here to help. And we can talk about, it's a very nuanced market. And even though we're talking about it globally, as in Central Oregon or Bend, it's a neighborhood by neighborhood. It's a age class of home. It's a style of home. It's, what are the demographics and what is the buyer set for your home? It becomes very laser specific to your strategy as a buyer or seller. And we're happy to go through that with you anytime. So, Steve, once again, we tried for 20 minutes and we're at 34, but that's not too bad for us. So, thank you all for attending. And as always, feel free to use this as your resource.
Thank you.